Welcome to today's episode. We'll be diving into an essential topic for all investors: risk management in investing. Whether you're just starting out or are an experienced investor, managing risk is crucial for long-term financial success. By the end of this episode, you'll have a better understanding of the key risks involved in investing and practical strategies to manage them. Let's dive right in. So, what exactly is risk in investing? In simple terms, risk is the chance that your investments will lose value. All investments, whether stocks, bonds, or real estate, carry some level of risk. However, instead of trying to eliminate risk, the goal is to manage it effectively. Investing always involves a trade-off between risk and reward. Generally, higher-risk investments like stocks have the potential for higher returns, while lower-risk investments like bonds tend to offer more stability but lower returns. The key is to balance these risks based on your personal financial goals and comfort level. Pause 3S. Chapter 3. Types of investment risks. In this chapter, we will delve into the various types of investment risks. It's crucial to understand these risks to make informed decisions. Let's discuss some important topics that investors often talk about. First, let's talk about market risk. This is the risk that the value of your investments will decrease due to overall market conditions. It's something that affects all investments to some degree. Next, we have credit risk. This is particularly relevant for bonds and other debt securities. It's the risk that the issuer of the bond will default on its payments, leaving investors with losses. Then, there is liquidity risk. This is the risk that you won't be able to sell your investment quickly enough to avoid a loss. It's a significant factor for investments in assets that are not easily tradable, like real estate or certain types of bonds. Finally, we have operational risk. This includes risks arising from a company's internal processes, systems, and people. For example, a company might face risks from fraud, legal issues, or even natural disasters that can impact its operations and, consequently, its stock price. Each of these plays a significant role in shaping your investment strategy. By the end of this chapter, you will have a better understanding of how to identify and manage these risks effectively. Segment 3. Diversification: Spreading Risk. Diversification is one of the best ways to manage risk. It simply means spreading your investments across different asset types, industries, and geographic regions. Here's how it works. First, across asset classes. By investing in various asset classes like stocks, bonds, and real estate, you reduce the risk that a downturn in one class will hurt your entire portfolio. Second, across sectors. Even within the stock market, you can diversify by investing in different sectors such as technology, healthcare, or energy. This way, a slump in one industry won't drag down your entire portfolio. Third, geographic diversification. Investing in markets from different countries can also reduce risk. If one country's market suffers, others might still perform well. While diversification won't eliminate risk entirely, it helps reduce the impact of any single investment performing poorly. Segment 4. Understanding your risk tolerance. Next, let's talk about risk tolerance, the level of risk you're comfortable taking on. Your risk tolerance depends on several factors. First, time horizon. If you're investing for long-term goals like retirement, you can afford to take on more risk because you have time to recover from market downturns. For short-term goals, it's wiser to take a more conservative approach. Second, financial goals. Your specific financial goals also play a role. If you're aiming for growth, you might be willing to take on more risk with investments like stocks. If preserving your capital is the priority, you might lean towards safer options like bonds. Third, emotional reaction to volatility. How do you feel when the market drops? If you tend to panic, you likely have a lower risk tolerance. On the other hand, if you can stay calm and think long-term, you might be more comfortable with higher risk investments. Knowing your risk tolerance helps you make investment choices that align with your personal comfort level and financial objectives. Segment 5. Managing emotional risk. One last important element of risk management is controlling emotional risk. Emotional risk arises when investors make decisions based on fear or greed rather than logic. Here are a few ways to avoid falling into emotional decision-making. First, stick to your plan. When markets get volatile, it's easy to panic and make impulsive decisions. Having a solid long-term plan can help you stay focused during these times. Second, avoid timing the market. Many investors try to time the market, buying at the lowest points and selling at the highest, but this is nearly impossible to do consistently. Instead, focus on staying invested and riding out short-term market fluctuations. Third, dollar cost averaging. This strategy involves investing a fixed amount of money regularly, regardless of market conditions. It helps smooth out your investment purchases over time and reduces the emotional impact of market volatility. By managing your emotions, you can make smarter, more rational investment decisions that will benefit you in the long run. And that's it for today's episode on risk management in investing. We've covered key types of risk, how diversification can help, and why understanding your own risk tolerance is essential for building a solid investment strategy. Remember, risk is a natural part of investing, but with the right strategies, you can manage it effectively and stay on track to reach your financial goals. Thank you for tuning in. If you enjoyed this episode, don't forget to share it with others who might benefit from this information. Until next time, happy investing.